Hello, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is, what is today? Wednesday, February 7th. Great to be with you guys this morning. Michael Boutros on the wires, Carlos, Iman, all three Pete's are in the house. Great to see you guys. Pooja, Tom, Mark, always a pleasure. So on the docket for today, it's been an awesome few days. I hope you guys are enjoying the volatility. We still want to pick and choose which setups we're actually operating on. I see your question, Peter, earlier on Pound Oz. That's been very clean. The Aussie crosses in general, in my humble opinion, have been very, very clean. And some of the crosses that we've been looking at on the intraday charts, the ATRs are just huge right now. So 110, 150 pip ranges, really nice setups to play with. So real quick, we'll go over the DXY, just where we're standing right now. But from last night, Kiwi, I'm more inclined to still look higher. We've gotten a pretty significant pullback in overnight trade, but I still think that outside day reversal yesterday and the resilience that we've seen in the Kiwi versus the Aussie, we talked about that in the webinar yesterday, still has me thinking that that could get a bounce. On the other hand, we'll look at Aussie dollar, held just as we were looking for last night, right at that median line. We've moved off. Want to be a little cautious down here. Pound Oz and Aussie yen we'll talk about. Tomorrow's obviously the Bank of England interest rate decision, so we're going to go over in detail the sterling trade, where it stands right now, both on the whole and on the near-term picture. Crude, I don't really know what to do with that right now if you're not in a position, guys. If you're short, I think it's a good hold, but we are probing below support. So we'll take a look at crude prices, and then we'll circle back to Sunday's update on the euro and where we stand there. Any other questions or trade setups you guys want to review? As always, feel free to throw them on the message board at any time. Morning, Michael. Can we have a Kiwi yen, please? Sure, Eman. Gotcha. Haven't looked at it today, but we could definitely take a look. Kiwi yen for Eman. Gotcha. Okay, so let's get started. Here's what we've been following. First of all, DXY, real quick, the larger picture, you guys know I'm not going to bore you with this again, where we're rebounding off of pretty important bearish invalidation, still up at 91.30. So, the broader picture still remains bearish, but there is room for a little bit more of an upswing here in price. So on whole, dollar probably still has a little bit more to go. Here's what it looks like on the daily charts. Basic slopes from last year's high. Median line, break, saw acceleration, resistance, that converges right around that 90, what is that, near term 90.50 or so. Now, on the intraday charts, this is what we've been following. And note that on the daily chart, guys, we talked about this earlier, but just to highlight why we're looking for the rebound to begin with. Not only the risk sell-off should keep this thing afloat, if anything, but you're looking at, you've gotten some pretty ongoing steady divergence all throughout the month of January as price action continued to make a lower low, a lower low, a lower low, all in closed basis, right? Only looking at this from the closed charts. Lower low, lower low, lower low, and a series of equal lows in the oscillator. Again, weak divergence because it's below 30, but then you got the trigger break. So there's a couple of different things that suggest, yeah, okay, cool, maybe a little bit higher in the index, nothing to go crazy with. Here's what the intraday chart looks like. So the descending channel that we were looking at, we saw the break offer some resistance, a new pitchfork that we added last week. I'm surprised it's still holding. I told you guys it was too early to work with it, but it's starting to look pretty darn good. So that pitchfork is still in play. Here's what it looks like on the 120-minute chart. Pretty clean on the median line. Topside break just missed those former swing lows, the 50 line. That's right around 90.11. And there's that 90.50 range that we talked about just a couple of minutes ago on the daily chart, right around here. That slope. Well, that converges on the 50 line for the upper parallel here and completes a 1618 extension from the advance off the lows. So if we topside break this median line again, that's sort of where I would expect price to drift towards. Near-term support, look for 89.55. Okay, former swing pivot lows. You also have a nice pivot in price here. You have the 50 line there too. And that's pretty much the price action I want to see. If we pull back, I'd like to find some support here for that last stretch. If we break below 89.55, I wouldn't go bearish. Okay, if anything, I'd be neutral. I'd really want to necessitate a break of the lower parallel before I start to look, for a bearish resumption trade in the dollar. So near term, looking for one last stretch high, maybe another push either towards 90.11 or 90.50 for a possible exhaustion trade on the index. Any questions on this? Okay, so to jump into the updates as of late, here was last night's update on Kiwi dollar. And here's what Kiwi looks like right now. So the weekly chart, right? That was number one. This is number two. The weekly chart. So we started off the week talking about 73.90, basically 74 into this region right here, which is 72.60s. Okay, you have the long-running 200-week moving average. Very decent pivot in price, and that one would give us a nice little range to work with to start the week. Last week, the objective, if you guys remember, as we were probing 74, was to look for exhaustion. And that was the game plan for what we're looking at in Kiwi. Daily chart looked like this. We had probed through the upper parallel. Okay, we did get a daily close above there too, so I was getting completely skeezed out that this thing might just completely rip right into 74.80 zone. But then we noticed that we were seeing some ongoing divergence in momentum. We talked about this. Big old outside day reversal here on the 2nd of the month really changed things up. That outside day reversal was accompanied by a momentum break in RSI and shifted the focus lower. 72.60 was the game plan. Again, if you guys look, always have the previous update at hand. Here's what it looked like as we were just coming off of that upper parallel daily chart. Okay, and we were looking to fade exhaustion below 73.90. We got one last push higher, and the pushback finally gave us that 72.60 level. From here, okay, we've now posted an outside day reversal off support. So that would suggest, or at least near term, just from a candlestick formation type of play, would suggest you have some upside to go there, right? A little bit more of a bounce. Now, you still have to make it through the monthly open. You still have to make a concrete break through the upper parallel again. But, that kind of reaction at support, specifically on a day where the dollar was really, outperforming most of its major counterparts or all of its major counterparts yesterday into the open of U.S. trade. We were talking about that here in the room. That resilience would have me looking for a little bit more of a supportive play. Another reason why I thought this thing might still head higher is that 72.60 level, which was a basic longer-term 618 retracement that we've been following from the decline off the highs we made last year, right? That same 618 retracement converges, right on a 100% extension from the decline. So if this is just an ABC simple, correctionary path, 3 waves down would put you right there. And you would look for resumption with a break back above 74, that same key level that we were looking at last week. So price action now, here's what it looks like. Okay, we got that bounce yesterday. The advance looked pretty good. We were testing that near term just pivot, okay, at 73.40. And I noted yesterday that we needed to get through 73.64, which is the monthly open. And more specifically, that 74 level again comes up as not only near-term channel resistance, but also those former swings, what we were looking at on the daily chart there. Let me get you where that level is derived from. Well, in any event, you get the picture. 74 resistance, 72.60 support. So at the end of the day, we're looking for some support on this move back. We take a closer look at price action at the 120, even the 60. Get a little bit closer of a look at what's going on here. One thing I was looking at earlier was this. Okay, if we're just that and look at the 100, you can see that we really made it through there. Didn't see any pretty much little hesitation on the way down. So I'm not really going to pay attention to that, but that 1618 extension comes in just above the February open. So it's 73.64, 73.66, the region of near-term resistance you need to break to even see a test of the upper parallel. That said, on this pullback, where do we look for possibility for support? That's 618. And the 50 was what I was looking at last night. You can see we're breaking the 50 right now. So, excuse me, look for 72.93 as the possibility for some support on this. Right here. into the US Open. Let's see how we react down here. If we're able to get some sort of immediate rebound low, look for a signal in momentum, specifically if you hold at 40, if you get a momentum trigger break on the resistance, that would be a decent long against that low to look to play the move higher. Keep in mind also yesterday, while I was writing this report, we were above the initial weekly opening range high. Here's your weekly open. You set a high, you set a low, a little bit of consolidation. The break higher should have had us like getting a more assertive run. So on this pullback, that's really the only thing I'd be willing to stay constructive while above near term. At the end of the day, 7260 is still your near-term key support level before we get excessively bearish. But right now, for that setup to play out, we kind of want to see this thing find a little bit more of a support bounce here near term. Let me just see what this looks like too. It's not the cleanest setup, but the lower parallel nonetheless comes in that same region, right? So just below 73. Let's see if we can't find some support there. Any questions on Kiwi? Okay, hunting for entries here. Again, no impact, guys, obviously on the swing side of things. So if you're taking the positions on the swing trades, don't let this alter your game plan at all. We're sticking with that as is. But as it stands from an intraday standpoint, if you're looking to get into something new, that's sort of the immediate focus for me heading into the US Open. All right, that's number 2. Number 3, Aussie dollar. This is my favorite. So the Aussie crosses have been what my primary focus has been on. The price action has been very, very clean. Here's what Aussie looked like last night. We can go to the previous updates, but you guys know we've been following this day by day. The break, obviously, below 79.50, 79, basically that swing low is really what validated the continuation and the break of the median line. We rebounded just pips ahead of the lower parallel. And then as we came up yesterday, the weekly open was standing as resistance at 79.12, 79.13. And even, even it had me just throwing in some humor there. I was just saying, would it be too much to ask for a hold here? Because it was a perfect resistance tag. You had the median line for the current operative structure. You have the weekly opening range open, or weekly opening range resistance, rather. That's something you should be paying attention to. And, a level from there, you'd be looking for a drop again towards the 50 line. Subsequent targets down at 78.13, 78.19. That hasn't changed for a while now. So the downside targets remain unchanged. We were looking for a hold there. Here's what it looks like. Okay, it worked out really well. We held right at that level all night long. And then the pullback here, trading just pips away from that 50 line. So that's your first level, guys, if you're holding this trade. I don't want to, prompt anyone getting out preemptively, but for me, that's a first level of test of support. If we see any hesitation, might be worth it. Take a little off the table. Stop should be at break even at this point anyway. So all things remain the same. At this point, near-term resistance will lower that from 79.12 right to the confluence here, back at 78.94. This zone, 78.86, 78.94. This is new resistance. New near-term bearish invalidation. At this point, I'll drop to the 50 line. Now it converges again on the weekly open where resistance was yesterday, but that's far out. So watch that 50 line in time. It still comes in right around 79.30 or so. But you get the picture, right? Near-term resistance here. If you're not in the trade, I'd be looking for a possible re-entry there. If you're holding the shorts, 50 line, watch that slope, okay? Because this is a real chopped up market, guys. So it doesn't pay to get into a trade and fall in love. You see that on a daily basis for the last 2 days, the Dow has given us 1,000-point ranges. Okay, we're living through history here. They're going to be writing books about this stuff. Now, on a percentage base, that's not that much, right? Because obviously we've traveled an enormous way up from where we were. So 1,000 points on a percent basis for the Dow is not going to be, earth-shattering, 4 or 5%. But at the end of the day, the sheer volatility and sheer move is significant. Now, you heard me yesterday in the teaser for the article tell you that, after these kinds of huge swing days, I might be eating my words later today, but historically, looking back at price action, you tend to see a day or two of lulled price action. So maybe instead of 1,000 pips, we do like 500 points in a Dow. I don't know. But typically, you don't see those big surges in volatility last for 1, 2, 3, 4, 5 days in a row. So, expect things to simmer down a little bit, which is why, again, I'm very nimble on these trades. It's still relatively early in the month, but all things held constant here. I'm looking lower, sub 78.90. Watch that 50 line. If we break below the 50 line right here again, onward we go down to 78.13, 78.19. That's going to be a bigger Fibonacci confluence, and has also been a pretty decent pivot in price. Resistance, break, support, support, support. And it's a Fibonacci confluence, not only the 50 from the advance off the lows we made in December, but also a longer term 50 from the decline that we made off last year's high. Questions on Aussie. She's a beauty. Eman saying, fabulous setup for Aussie. Play it short yesterday at 78.96. Very nice. Thank you for guiding us. Cheers. Hey, man, I'm only showing, they're not my levels, they're the market's levels. I'm just helping you find them, right? So give yourself the congrats on that one. Very, very well done. So again, I'm looking to see if we can't get through that 50 line. Things look pretty decent, but the momentum signature, you look at things like this on the 120 or the 60-minute chart, I kind of don't want to see these types of slopes last for too long. I want to see us kind of make it through there. And that would validate sort of the continuation for the move lower. But there's going to be a snapback at some point. I just don't think we're there yet. And I think we're not there yet because everyone's saying that we're there. So you kind of the contrarian view. If you just listen to any of the news publications this morning or CNBC or Bloomberg, everyone, now that we've had this one day of bump higher, everyone seems to think, oh, that was just an anomaly. So look, markets don't just V off the bottom with big, big surges in volatility like that. So expect back and forth. All right, expect back and forth. Any questions on Aussie before we move off? I didn't really think we were going to get anything from, or we went over the RBA yesterday anyway, so no big deal. Same thing with Kiwi. I didn't think we were going to get anything off the data, and we didn't. It was kind of a bust. All right, Aussie, going once, going twice. Hey, Pete, this is for you, man. Pound Oz. Here's what Pound Oz looked like last night and the game plan. Another Aussie trade that I just loved. And I just loved where Sterling was and Aussie was accordingly, respectively, in their each pairs versus the dollar. So for me, I told you things were acting a little funny, right? On the way down, our target was the previous day. This 100% extension is a newly added target that I added last night, but the target was really 75.68 on the way down. A basic 38.2, you had basic channel support just below the 50 line. But it started to act a little weird here. And then once we broke and tagged the 50, this is actually a 38.2 line, mind you. I'll show you that in a moment that you're looking at in blue here. Once we tagged that, you notice that we saw some divergence in momentum. And those are things I'll pay attention to. So you got a strong rebound off the median line on building divergence. Then what happened? You started to see consolidation. Lower high, higher low, lower high. And these types of consolidations, again, I typically wait them out. I don't want to play inside them. Just doesn't pay, even from a short-term standpoint. So the game plan was if you were holding shorts, stay bearish below 77.65, bearish invalidation at 78. If you're not already short, we were looking for an entry on a spike into that level. Ultimately, for a move down again towards 75.93, 75.68, nice little key zone of confluence support. This play worked out perfectly. I mean, give me a pip or two allowance. But it just was a beautiful, beautiful play. Where's Pound Oz? So here's what it looked like. Okay, we spiked right into that level. Okay, let me bring that chart back. We spiked right into that level really quick. The high came in just shy of it. The high was 77.58. We were looking for 77.64. And then it just reversed and collapsed lower right through the session lows for that trade session. Now, this outside candle, again, here we go back and forth. Same game plan. Keep in mind that the drop was over 110 pips. So if you are getting into trades like this, guys, this is what I mean by being nimble. Okay, a quarter of the daily ATR here only calls for like 40 pips. So on the way down on that kind of move, you're taking a chip off, you're bringing your stops to break even. If you're close to break even on this rally and it hits break even, I would just get out. The play was playing that recoil off that region. If we fizzle through it, game over. We shift our attention right back to the upside. All things held constant, we're still trading within the confines of this descending channel. And this is a messy chart, like I said yesterday, but you just want to kind of keep your focus on the levels that are highlighted. So still bearish, basically below 77.64. That's the level you'd need to break. 78 is the top side that would put you right back into resumption. And in such a scenario, you're basically looking for a stretch all the way up back into like the 80 handle, 180. But ideal scenario, you start to fail here again. Possibly get a short exposure, guys, in US trade today against that high if you get a decent trigger. And then look for that drop towards 75. Let's just call it 76, this region right here. Peter, you're the one who wanted a question on this pound Oz. Talk to me. Do you have any questions? Look at this on the near term. Here's the 60-minute. He says, thanks, it's good. All right, right on. So you can see these near-term consolidations again. You know what I mean? Really can mess with you sometimes. So just keep your eye on that. I still like the setup. I mean, you're in the trend until you're not. You're in the down slope until you're not. As it stands, nothing necessarily in momentum to get us too concerned. In fact, 60 still holding as resistance pretty much on every uptrend here. But you're seeing the 40 support hold us on the pullbacks. So 40 support, 40 support. It's typically more of a, from a momentum standpoint, Pete, that's more of like a lateral range type of momentum profile, at least over the last 24 hours. So look for a resolution of this near-term consolidation. Ideally, you get that last poke down towards 676. Sterling Oz, going once, going twice. Oh, the one thing I did note yesterday in the report, I kind of just wanted to throw it out there again. It wasn't highlighted on the intraday charts, but where we bottomed yesterday was the exact almost monthly open support. So here's your monthly open. And this is why I think, I'm not too surprised to see a little bit more of hesitation before it breaks lower, because if we do finally make it back below the February open, that would inherently be a near-term short bias. So keep that in mind. All right. Next up, that was pound Aussie number 4, another Aussie cross, my love lately, Aussie yen. And it's an abomination pair, so you'd be surprised to see me write about this for so long. This thing we've been following every single day pretty much, guys, for the last couple of weeks. You could sense my gratitude in the cleanliness of the play with yesterday's update. The last target that we had noted for you guys was 85.40 into 85.36. That was a nice Fibonacci confluence, a 618 extension, a 786 retracement. Beautiful, beautiful level. And, it was ahead of schedule, but just a couple of hours later, and it would have converged on the 50 line. So we broke below that. Obviously, at that point, that was the last target, so we weren't in it. But even the drip lower just basically probed below the December open, which is the level that we've been watching, before, quickly reversing back. You never got a 4-hour close below it. Yesterday, as we were writing this, we noted we were back at 86.71. And if you've been following along, 86.71, 86.72 has been our bearish invalidation level for some time. So what does that mean? It means the focus is weighted to the downside so long as we hold below that level. Okay, that's the bearish invalidation. What that means is if we break above that, you don't necessarily just want to buy. But at that point, we're no longer looking for short exposure, right? Because we don't know what's going on. That changes things. So, the ideal scenario was for us basically to hold right there at 86.72 and pull back. So I told you yesterday I wasn't really, a fan of fighting this just yet. I'm kind of kicking myself now, but at least you got the opportunity to get in a little bit later. The break below 86 would put this in a more bearish stance, and that's what we got. That's what we got. It rallied into 86.72. Is a beautiful hold. We went right lower, and then once you broke back below 86, the median line really validated the sort of the move. Again, I missed this one. Didn't get a chance to really participate on this last pullback, but from last night's update, really, just really clean. And there's the break back below the 86.16, 86.20 pivot. That's now resistance. Downside move, you're still looking for that drop extension to 85.36, 85.40 again. Again, the December open would come into a play as another target as it coincides on the 50 line there, but you get the picture. From a trading standpoint, so things worked out ever since last week. We were looking for the consolidation break lower, took out all the targets. You had an opportunity to actually play the rebound, but even then, we came into bearish invalidation, gave us another opportunity to get short with another drop of over 100 pips to the downside. What do we do from here, Mike? If I'm not involved or if I took that short and I'm out? Well, this is the problem. Now you're sitting pretty close to the mid-range of the week. Here's your weekly range. Then this is where it becomes more difficult because you're not up against the resistance confluence. You're not up against the support confluence. So if you don't have open exposure from here, I don't want to encourage chasing specifically in this market condition, guys. It's just not going to pay. So, you know, the market will always offer more opportunities. So if you weren't able to get in on this, again, I think we'll get plenty of more play on these crosses, which have been just real clean. Put a gun to my head right now, I'd probably think you still get that extension to 85.40 rather, 85.36. You know, but if we break above the 86.20 level today in U.S. trade, you know, I don't want to be a part of this anymore. So that's sort of the game plan here, at least as it stands right now with Aussie yen. Just keep your eyes on those levels. They've been playing out really well. Bearish invalidation for the broader trend. Again, we have to keep it steady at 86.72. It's still the level to look for. If that breaks, you know, we could see a much larger recovery in Aussie yen. Here's what it looks like, by the way, on the daily charts. Look where we bottomed. This is why our last target was 85.36, 85.40. Why? Basic 786 retracement. It was the that high day spike, right? And then basic slope support. This is the same slope we've been following off the 2016 lows. So we've been in this slope for nearly 3 or 2.5 years now. Median line obviously being instrumental into the 2017 opening range low, or into the 2017 open rather, that break saw the decline to the yearly lows. The rally for the year failed again at the median line, failed again at the median line, broke below the 50 line, which we tagged as support earlier. And to start the year, failure, failure. And as we noted, we've been following this thing all since the start of the year. This is a break of the January opening range, which never gave out. That's why we got so bearish, right? Multi-month range that finally gives out. You look for the extension lower. That's the move. A little more cautious here. You know what I mean? But I think you still have to respect it. Any questions on Aussie yen? Expect sideways, maybe to higher in the near term. Ultimately, still looking to see if we can't get another push lower. Going once, going twice. Let's move on to the previous update. So that was all of last night's trades from before. Pound dollar. And obviously the BOE is on tap next week. So look, pound Aussie, we're still going to be, you know, that's still going to be, for me at least, my personal focus as we get into the BOE as sort of an offshoot, so we don't have to deal necessarily so heavily with the dollar. So this is a setup that's at least clean. Watch this. You know, on a pound weakness story, look to fade strength. Pound dollar looks like this. And, you know, I'm really kind of torn on how, or if there is a setup for us here. And I'm starting to think it's not necessarily there for us yet. Just adjust this perfectly here. But here's what we were looking at early in the week. Well, you guys all know the weekly chart, right? Do I need to go over this again? You guys all know the weekly chart for the pound, super clean, you know, has been absolutely magnificent as far as holding the confines of this ascending formation. And ever since the start of the week, this is the level we've been talking about. Now, what's important is going to be the weekly close, okay? Not necessarily intraday. If we close back above 39.50 on a weekly close basis, that wouldn't be, for me, an interpretation of a break of support. So this week's close will be important. Keep your eye on that, okay? Keep your eye on that. Daily chart looks like this. 39.43, former swing highs, tagged at twice as resistance. Once we broke through, we saw acceleration, converged again right at the median line. So again, the same thing that we're looking at in the weekly chart. Daily close below, we still have not done. Here's today's candle. So we yet still have to close below that 39.43. Watch that level. Watch that level. Intraday looks like this. That's 618. Or first of all, the 39 and change level, okay, 39.43 is right here, but 39 and change level right here, you had the 100% extension from the decline. You had the 50 line, or the median line rather, coming through, and the median line for the downslope. So for me, this was a huge level. We talked about this late last week, early this week, and was the last level of support that we were looking for as far as, looking for a possible rebound in sterling. We broke through, tapped the 618, and then broke right back above. Here's the pullback, now starting to respect the median line. So, how do we interpret this in price? Well, if we had gotten a decent divergence signal here, this is technically divergence because these are equal lows as a new extreme in price is registered, but it's the pound. It's a notoriously professionally traded market. If you were to put a gun to my head, I do think that you get one last swing higher to make a new high. If this thing's going to break down again, the 38.40 level would be the level of which, okay, just straight bearish from there, at least on the near term. But if this is going to rebound again, top side, wouldn't be too surprised if we get as high as the 140 region again. So I hate to be a little bit less, or it's a low conviction trade, guys, at the end of the day. A long here against the lows makes sense from a risk to reward ratio, just looking at least for the upper parallel, or if not, that extension to 140.30, 140.28. But you're trying to play a turn on a pretty steep downturn. So just, use some caution, guys, prudence. If you're not involved in this yet, there's nothing here necessarily that's super pressing. But for the BOE, obviously, which is on tap tomorrow, if it does charge any type of volatility, I'd be interested in either fading a drop and a failure to hold below 38.40s, or if we rally right into the upper parallel, and it's a little bit more of a dovish stance. If there's Brexit talks, concerned about inflation, yada yada, that might be an opportunity to fade it for a near-term downside move. But from here, ahead of the interest rate decision, I would probably you'd probably better off serve just keeping the powder dry. At least on sterling dollar. Sterling all is a different ball game, but that's sort of the game plan for pound moving forward. Any questions on sterling? Okay. Number 7 will be crude. Not what can we say? We're getting a breakdown, okay? The level that we were talking about in crude prices to start off the week was here. So, we talked about this upslope on the daily chart. We got some radical divergence on that last spike through the median line. And, obviously this screams exhaustion. So, I would have allotted one last spike into 67.14 for a breakdown. You didn't really get it, okay? And once it started breaking down below 64.78 right here, that's when things got interesting. Why? Well, the near-term picture had some stuff there too. A basic modified pitchfork, a shift modified pitchfork, by the way, off the decline from the highs gave us a median line right there at the same level, 64.78, but a parallel that you see here in red of the same slope extending off those lows gave us pretty nice level as well. Support, the break saw acceleration, and then you got a perfect support bounce yesterday or earlier in the week. So for me, this was the game plan. Okay, we opened the week. This was ahead of the weekly open on Sunday. You're saying, look, if we get a dip into this region, that's the near-term support. Our bearish invalidation and resistance is 66.07. It's the 4-hour reversal close from last week. So as long as we stay below 66.07 to start off the week, you're looking to sell rallies. Well, we opened the week, little bounce off that support zone. Then we broke below, and we came right into that downside target at 63.20. That's where we're trading right now. We've probed below. I don't know what you want to do with that. You know, I wouldn't necessarily call that a break. Certainly wouldn't be interested in shorting at fresh weekly lows. So if you're not already short here, I don't really think there's anything for you unless you get some sort of near-term recovery. If you are short, I definitely would be taking a little off the table. If your entry is northbound is 64.20, I would be putting stops above that high, okay? Because that would coincide with that parallel again in red that we've been following. If your entries are below 64.20, I'd have them at break even or better at this point. But just to put things in perspective, guys, if we are to break lower from here, there's a lot of room. 62.56 is just a soft target, and the only reason I highlight it is because it was the 2015 highs. If we go all the way back, well, you can't see it here on the intraday chart, but on the daily chart. Okay, so it's those 2015 swing highs right here. All right. So that would be a soft target, but really a 100 or a measured move off the high gives you 61.44 on a downside break. And that's the 1618 off the high. So this level right here. So the risk is there. Momentum is definitely not on your side. You're getting divergence as the oscillator fails to prove a new extreme in price. So, you know, the stage is set for a possible rebound. I wouldn't want to try to fight this. I wouldn't try to fight this. So game plans. Well, if we get a pullback higher, as close as you can get to these former highs for a stop, if you're interested in trying to fade that move on a trigger, great. Other than that, if you're holding the shorts, stops at break even. Next target 62.56 and 61.44. Okay. And by the way, on a move lower, okay, into one of these levels, if you're not on the short, I would be looking for exhaustion, possible long entries. You know, this is kind of a far-fetched target. I don't personally, and this is just my humble opinion, guys. I don't really think we get quite down that low. But if we get into the 2015 highs, I would be looking for possibility, for a possible entry. Just keep that in mind. What OCS do you use? What oscillators do I use? Is that what you're asking, KP? So on the daily charts, you will see the 100 and 200 day moving averages. On the weekly charts, KP, I'll have the 52 week and 200 week moving averages. You know, a lot of times you'll see me and Jamie alternate. Sometimes I'll throw on a 20-day moving average there when I'm trading, because a 20-day moving average actually sometimes ends up being really nice support. Not on all the pairs. These behaviors are like on a each pair has like its own characteristics, where for some reason a certain oscillator, a certain technical indicator will have a better you know, grasp on that market for some reason. But anyway, I digress. That's pretty much the breakdown that I use, KP. Did that answer your question? Daily charts, usually 100 and 200. Weekly charts, 52 week, 200 week. And again, for near-term trend type of use, a 20-day moving average sometimes can be very helpful. Okay. Questions on crude prices before we move off. Last but not least, of the planned scheduled pairs, let's talk real quick about euro dollar. Oh, the bottom one KP is asking. Oh, so this is just basic RSI, relative strength index, just a basic momentum indicator, KP, to help us identify what the momentum profile is suggesting as far as, you know, near-term price action. But, you know, as I always say, all of these momentum indicators, all oscillators in general, KP, are backwards looking, right? They're not telling you what's going to happen. They're telling you what happened. So all you're looking for is real subtle changes in the oscillator to help you identify whether a market is either oversold or overbought primarily, but also, you know, little tidbits that we always talk about. And this is something we can go into a separate webinar all about, KP, but, you know, in strong uptrends, momentum will tend to find support at 40 or above. In strong downtrends, momentum will tend to find resistance at 60 or below. And, you know, there's a lot of information that can be told from the behavior of what momentum is doing. So let me know if you have any more questions on that. But otherwise, let's look at euro dollar. So from the update on Friday, or the previous update, here's what euro looked like to start off the week. This thing is pretty darn clean still. Now, the index obviously has made a break higher, and it looked pretty clean. So that would inherently put us in a downtrend sort of play on the euro. For the euro, I'm not sure. Did we have that pitchfork on? No, we didn't have that pitchfork on yet on the Sunday Open. So here's what the Sunday Open looked like. And basically, we're looking for either an exhaustion trade up into this region for possible shorts, or if we break below the parallel, and that's kind of what was the game plan, it was like an either or statement. It's either a break higher for a rally towards 79, or excuse me, 25.98, or the ML to try to get the fade, or larger correction towards parallel support if we break the median line. That's exactly what happened. We broke the ML, it moved lower, and we're now basically checking channel support. Now, yesterday when we came into lower parallel, it was a very strong reaction. Yeah, those former swing highs here from January opening range converged right on the lower parallel. And if that weren't enough, the median line for the current formation that we're following was right there as well, right? So we spiked right into that and we rebounded higher. So for me, that looked very interesting as far as a near-term sort of exhaustion play. Look for a rally towards 24.10. This is the break that would validate a more substantiated reversal in the euro range, which is basically what we've been in since the since late January. So resistance 24.09 never got tagged. The high was 24.05. We turned lower. Here we are back again at support at 23.20. So look, at the end of the day, this is your immediate range. A topside break looks for a resumption straight up of the broader uptrend that we've been following off the lows from December. Nothing changes there. If we break here, though, that would suggest that we're underway for a larger correction. In such a scenario, watch slope, obviously, but from a lateral level of support, a basic 38.2 of the advance still takes you all the way down as low as 122.20s. Okay, so it's make or break here for the euro near term. My preferred play was to see the breakout. Okay, and the dollar gets a little bit of a respite, cool, but we're still within the confines of the uptrend. So the impetus right now for the euro price action into the open of U.S. trade is whether we break below this threshold or not. I'm more inclined to like a hold here. That's just me, but there's nothing necessarily worth or screaming to press a trade here just yet. So euro simply testing uptrend support. Okay, very plain and simple. It doesn't get much cleaner than that. And that's pretty much all you need to know here. Any questions? Okay, so that's everything I had on my list. Let's take a look through some of your questions. Guys, really quick, the TNX chart that we followed the last couple of days. I also wanted to give you the opportunity. Someone was asking about this yesterday. If you want to take a snapshot of this, this is the 30-year or 10-year, yield. And as the yields explode to fresh multi-year highs that we haven't seen since 2014, it's important to keep in context slope and where we are. There's a basic trendline resistance extending off the highs that we made way back here in 1994. That huge long-term trend line converges on the 50 line, and again you have that 618 extension that gives you basically 283 into 290. So the yield story, I think, is gonna continue to well, it will be coming more to the forefront. I can tell you that much right now. Specifically, the breakdown in price, the breakout in yield, same difference, is something that I think it's going under the table. It's going to come more to the forefront once investors get a little bit more of a whiff of this. That huge bond markout breakdown. You're testing 30-year, multi-year resistance, multi-decade resistance. That's pretty big stuff. So underlying themes to follow. All right. So as per your questions, E-Man wants to take a look at Kiwi Yen. Let's see what Kiwi Yen's doing. Ugh, that is ugly, E-Man. All right, let's clean this up. Bear with me one moment. I just wish I had some slope on this. Huh, wishes do come true. Look at that. Upper parallel was pretty instrumental. Closed bases couldn't make it through. Even on a stretch basis at the high, you had a nice reversal right off it. Interesting. This one's a tough call, E-Man. I'll tell you why. Respectively, I do think that versus the dollar, each of these has its own merits for possible strength. Now, dollar yen, I'm going to come back to this in a second, but if you look at dollar yen, for example, what it's doing, the emphasis for me is dollar yen might hold this 108.70, 110.20 level for like another 5 or 6 days. This was a big range for me. This is a 50% retracement. You obviously saw some swing lows from last year there. We closed one day just below it, and we haven't been able to do it since. So, you have to look for a resolution of this range. The objective play for us once we broke below 110 was to look for a drop into these three targets. Those haven't changed from last month, right? 108.72, 107.86, 2017 low day close, and then an extension that also measures up pretty nicely with some swing pivot lows, some swing pivot highs, or excuse me, right here, swing pivot lows, swing pivot highs, right at the 1618, and that gives you 107.45. So this is sort of the main region of target of support that we're looking for on a downside move here in dollar yen. I loved how and where we were reversed, right? We couldn't close above 110.23 or 110.15. That close below in and of itself was basically a short bias against that high for the move lower. This right here, um, I really just don't know what to do with it, to be quite honest with you, E-Man. This is your monthly open. And you're sitting right middle of the monthly range, right? And we think that Kiwi is pretty resilient, and yen should catch the Haven bid even more so than the dollar, I think. And we're seeing that in the Aussie yen moves that we've been watching. I know Jamie's looking at pound yen yesterday with you guys, and he will be on later today, by the way, at 11 o'clock for the midweek strategy webinar. So keep that in mind. But so anyway, I digress. To get back to your question, Eman. So this is the dollar yen dilemma, right? Take that and transfer it over into the Kiwi yen, or with that in mind. I don't want to transfer it, but with that in Kiwi in mind. Momentum held here at 40 or above 40. Let's look what this looks like on the intraday. Oh, look at that. I already had that pitch drawn. Okay, cool. Yeah, from the looks of this, man, I think you get another move lower, but I think you buy that. Hold on a sec. 2, 3, 6, 7. I don't want that. Leave that 618 just because it's been a decent pivot. Resistance, support, support, support. Get rid of it. Now, a couple things I want to look at. I want to see the extension off the high and see if we've completed any meaningful ratios. The 100, so still just to complete a basic equal two-leg decline correction, just to complete that would still necessitate a move down to 78.7. That's my concern on this one. Let me make that red. Oops. Stop traffic. 618's all over. So yeah, look, if we're heading lower, and this is basically like the same plan that we had with Pound Oz, right? Yesterday, Pound Oz, the update, our specific game plan was, look, if this thing is going to head higher, advances should be capped by 177.64. It's exactly what happened. I would say the same exact thing here on Kiwi Yen. If this is going to head lower, advances should be capped by 80.51. We're exactly where we came off of just an overnight. You see actually a quick bisector line here. Not the cleanest. Bear with me, this might look messy. Just give me a second. Uh, 618 line, call both of those. Okay, I don't want to get too crazy with it on this slope just yet. It's pretty decent, but I think we'll work with the original one for now. So look, Iman, I'm going to try to break this down as simple as possible. Basically, what you've done is you've made a weekly opening range. Here's your weekly open. You stretch into a high. You make a new low at slope support, which is something we've been following. And then the rebound fails right at the weekly opening range highs. So for me, this is a weekly opening range break waiting to just give away. Obviously, it's a massive range. It's a lot larger range than you typically want to see. But we have to give it, what the market is. We have to take what the market's given. So at this point, once we break back below 79.50, in my humble opinion, you're right back on chance to get down in that 78.69 level. But expect more than anything, more sideways in my opinion, specifically on this pair. Does that make sense? Yes, thank you, says Eman. Hey, you're more than welcome. More than welcome. And that's all I have on my side, guys. Let me know if you have any other questions or trade setups you want to review. Here is the SPX. It's on the back of this latest fall off, guys. To keep in reference on where we are, where we kind of rebounded off of yesterday with that massive reversal. You had the 200-day moving average right there. We probed just pips below it before finally reversing right back up. We're right back at the median line. So guess what? Knock, knock. Here's resistance, 50% retracement, median line, or the 50 line for the current ascending formation. That gives you basically 2703. Okay, so we're not out of the woods yet. Look for a reaction there. If we break higher, you could even get as high back into this confluence region. But at the end of the day, this is near-term resistance anyway. Slice it for SPX, at least as we start off into the U.S. trade session. Okay. Obviously, the equity markets have had better days. Here's the Nikkei 225. We talked about this yesterday. This pitchfork seems to be in play. 200-day moving average just above the lower median line parallel, charged again. They're advanced right here. Very, very similar play. Here's the 100-day moving average offering resistance just above that, the actual concerted median line and former upslope resistance. So again, could be a little bit higher here in Nikkei, but at the end of the day, near term, you need to respect the downside below 2250, 2270 to be exact is the yearly open. So I know someone here was following with us the DAX earlier this week as well. Last but not least, gold trading at a very interesting level here. So where we were reversed off of the 2016 high day close, the 2016 high close literally almost caught this thing to the pip before we had a nice outside or a nice reversal candle there late last month. So here's the pullback. Here's what it looks like on the intraday. And this is what we've been following. This descending channel, very, very basic, has been just textbook. We opened the week looking for a support bounce off of 1325, a nice pivot in price and channel support. You didn't quite get that low before the rebound, finding resistance right again at the upper parallel. And then the breakdown again. Ultimately, ideally you'd see that last drop to 1316, 1317. It's a nice confluence region. 100% extension from the decline off the highs. And a 38.2 retracement from the advance off the lows. That's 1316, 1317 right there. So watch that level as a support in gold if this thing does break lower. Any other questions, concerns, comments, pairs you want to review? Anyone freaking out from all the volatility? Just know that this is our bread and butter, guys. Things the more volatile and the more oscillations we get in price, the more conviction you get both on formation, on slope, on levels. So things are shaping up to be a fun February. Okay, so I'm going to wrap it up there. If no other questions, what is your broader bullish invalidation for gold? Still 1246, E-Man? No, I think we need to bring that up. So Iman's been very attentive, obviously. That still in my trade says very attentive. 1246 is our bearish invalidation level for seems like years, Iman. That's been the sort of the level of which we were looking for. It was the second and third quarter highlighted bearish invalidation for the quarterly forecast that I write for Daily FX. We came right into that late last week. Last year, I was about to freak out because if we had broken below that, really, I was looking for this whole thing to fall apart. So no, I don't necessarily think you want to leave it still down there. On the weekly charts, unfortunately, that is the level or the range of which basically you would need to see a breakdown here to break this lower, but I wouldn't risk a drop that low. Daily charts suggest that let me see something here real quick. So look, in time, and this is the always thing that we always want to keep in mind. We always have to take into account what the time value of the whole thing is. In time, your immediate bearish invalidation, the thing that would put a straight bearish short gold at any cost, in my humble opinion, would be right here at 1263 into 1267. It's the broader bearish invalidation at this point. Okay, at this point. Near term, if we do break this confluence threshold, if I'm in a trade, E-Man, I wouldn't want to be on it if it breaks below 1295. Former swing highs. It's also the 50 line for the current upslope that we've been working in. The upper 50 line was decent resistance. A little messy here, but decent support up before the break. That line converges just here. And in a couple of days, the 100-day moving average will also be slipping into that range. So immediate, based on time, if the market just were to plummet, 1263, 1267 is what I would raise that to, E-Man. As you kick out further out in time, okay, this is the level I would want to see holding if I'm holding any type of long exposure. Does that make sense? Got you. Okay, says E-Man. Right on. Right on. But there is a bigger correction that possibly could be at hand here. And specifically, if the dollar breaks higher and gives us that correction, you could see this sink lower. But first things first, I'm looking for some near-term support or at least some sort of reaction here. A break, as we always say, of a downside slope, you'd probably see this thing just tumble. right towards that range right there, 100-day moving average, former swing high slope, right? But all things held constant, first thing focus right now for me is at 1316, 1317. Okay. Again, quick reminder, Jamie will be up in just about an hour and a half, so stay tuned for that. Till then, best of luck trading, guys. Watch the BOE interest rate decision if you're holding sterling exposure. Favorite sterling trades, in my humble opinion, sterling dollar is something that we'll be definitely tracking. Sterling Oz looks pretty good. Keep your eyes on that. And certainly we'll give you an update tomorrow morning, same time in the aftermath of the BOE. Till then, best of luck trading. I'll see you guys tomorrow. Cheers.